Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. And today is not a day without any action. We, as expected, had a Federal Reserve announcement today. And sure enough, they are raising interest rates. The Fed lending rate is going up 0.75 of a point, 75 basis points. That, however, is the largest single rate increase since 1994. And it was coupled, Miles, with an announcement that they do still expect to see 50 to 75 more basis points, or 0.5 to 0.75 of a point again next month. So, explain to us a little bit about what gold did in response to that, and let's talk about what the impact might be.
Yeah, personally, I'm actually a little surprised. I thought it was a very impressive showing coming out of the Federal Reserve. I'm sure there are plenty of people in the financial world who aren't happy about it because we've gotten very used to the trough, and we're taking the trough away.
Cheap, easy money trough? Is that what you're talking
about? Yeah, exactly. And I'm very impressed. And I'm going to stick with my argument that we still don't know if we're looking at Volcker or Greenspan. We're still looking at interest rates up at 2.5%. That is an incredibly low interest rate in the grand scheme of things over the last 100 years. We're coming out of zero and almost zero, and in some countries like Japan, negative interest rates. But still an incredibly low interest rate environment. So kudos, swing the bat harder. I'm all for it. I'm a big fan of austerity, and I'm a big fan of tapering back inflation. I'm a big fan of limiting the Fed's balance sheet. I'm also well aware of the pain and suffering that can cause for people who have been subject to borrowing and not saving. So I don't want to come at this cavalier.
Well, the pain and suffering has to be balanced with the pain and suffering that comes from high inflation.
Correct.
Really. So I appreciate what you're saying. I'll also say they should have done the heavy lifting a year ago when we first saw signs and everybody realized it probably wasn't transitory. So they wouldn't be doing it to this scale had they taken measures earlier. That being said, is it necessary? Yes. Another inflation number comes out this week. We set another new high, a 47-year high of 8.6% in inflation. If measured the way it used to be, that's actually 16.8% inflation, which I think every listener, every citizen would agree with is the reality. That is a 75-year high when measured the way it used to be. So these are unprecedented times, and you're right. Many economies have thrived and even exploded in an interest rate environment of 2.5% with the Fed lending rate. So you're right. I'm anxious to see what happens, all that to taper the inflation.
Right. And I think that's their point. I think taper is the key word here. They're not looking at just completely pulling the rug out from under things. And I think they're well aware that 2.5% is still, again, historically a very low interest rate. It's just zero is you can't do zero.
And what they're not doing is tapering. So let's stick on the word.
Right.
They have said that they've got to also start tapering. Fed balance sheet is still at all new highs.
Yeah, and that's
so
another argument we made a couple weeks ago.
Right.
So you can raise interest rate all you want, but if you also increase the Fed balance sheet, then you're not really getting anywhere.
The trough is still there.
Right.
Right.
So looking at how the markets reacted, surprisingly not much. You would expect with an interest rate rise, you'd probably see a bunch of markets fall. However, that wasn't the case. And the reason that wasn't the case is back your charts up farther than the last 24 hours. Oh, look, all the markets dropped about 10% in the last couple of weeks. So while I'm a bit surprised that they actually went for the big interest rate rise, it looks like most investors were not, because the Dow's off 3,000 points since the beginning of the month. The NASDAQ has crashed even further. The S&P's down even further. Gold even took a little bit of a drop. Gold went down in the last couple of days from like 1880 down to about 1815, 1810, and has bounced back up kind of right in between the two. So everybody was expecting this, and I think there was a pre-sell leaning into this. It wouldn't surprise me to see the markets kind of turn around and come back up a little bit. But you couldn't convince me we're going to be looking at continued bull market in the equities market.
No, and there's a frustration in the gold investor with all of these underlying fundamentals and the other markets doing what they're doing. We keep getting asked, why is gold not exploding? Why is it not taking off? It's all about perspective. Like, let's just even look at this year. You as a gold investor should be very, very encouraged. Gold is flat for the year, up just a hair. But measured against the U.S. dollar, the issue that we have beaten to death on this show is the dollar strength in terms of the index being at a 20-plus year high. So it's very encouraging that gold is held above the 1800, but measured in yen, it's up 18% this year. So it's all about the currency against which you're measuring. Well, at the same time, look at the cryptos. Where is your safe haven? Where's your hedge? It's cryptos? No, down 55% year to date, including today after the announcement. Bonds? No, down 25% year to date. That's a bloodbath, as David called it. Stocks? No. NASDAQ down 30% year to date. S&P down 20%, both in bear market territory. And here's gold flat. Be very, very encouraged. The fact that it popped up a little bit today shows, again, continued strength.
Yeah, I think looking at it relatively is the important thing here. The purpose here is to kind of wade through the volatility in the markets and the way money moves back and forth between these markets and try to bring a little method to what feels like madness. You're getting beat around. The Dow Jones is off 15%, the S&P's off 15%, the Nasdaq's down 25 to 30. It feels like a bloodbath, but what you're not seeing quite yet is safe haven asset movement. Now, you are in the long run. Gold has this dual purpose, and let's remember this. What gold does is it's going to maintain purchasing power on a long timeline. This is why we bring Rob in once a month and we overlay gold over the M3 money supply chart, and we look at what gold has done compared to inflation and money supply over the last 50 years, and you go, oh, they've done like literally the exact same thing. So that's one thing gold does, and gold is still doing that. There's a second thing that gold does, and it has to do with market sentiment. And this is the type of market sentiment that we want our listeners to not worry about. And that's the fear and panic aspect of market sentiment. So let's take a look back at what happened back, let's say 2007, 8, 9, 10. What happened during the first half of the Dow Jones fall in 2008? Gold went with it.
Yep.
The dollar did fairly well.
Everything gets sold off and moves into dollars.
Exactly. What happened during the second half? The Dow kept going down.
And gold took off.
And
silver exploded.
So there are stages in this. And the stages, it's a mindset thing. I mean, we're looking at markets, and I know we look at charts a lot here, and we talk about math and fib numbers and all sorts of stuff. And all that is just trying to figure out what the madness of crowds are doing. We're still just looking at the waves of people making decisions, voting with their dollar, so to speak. So how are people voting with their dollar today? Well, the way the equities market has been declining and the fact that the dollar index has been climbing, what that tells us is that internationally, people are looking at the rising interest rate environment in the U.S. and thinking this is a short-term safe haven. So internationally, you're seeing a lot of money coming into the U.S. dollars into treasury bills because they're expecting to see better rates of return.
It's strong dollar policy.
Yes. Now, I'm well aware we can have a longer conversation about this and bring in the concept of the inverted yield curve. I know that throws a monkey wrench into things, and this isn't the show for it. That's why Morgan writes his piece, which I think we can link at the bottom of this show.
Well, we also need to point the listener to yesterday's McIlvaney weekly
commentary. Yeah, this is one of those weeks where those of you that listen to our show, it's worth taking some time and going and checking out a couple other pieces that we put out weekly if you're not doing that already. So we'll put some links below this show for you guys to go check that out. But getting back to it, we're looking at a number of sources bringing money into the U.S. dollar. U.S. dollar is rising. We just talked about that. The equities market is down significantly. So think of that same pattern. We're going from jubilation, which is where the market was a couple years ago, the pre-COVID era, into a period of uncertainty. People get liquid during uncertainty. Uncertainty means uncertainty. It doesn't mean things are going to get bad. It means things could get bad or they could get better. So we're looking at a massive rush into liquidity. We expect things are going to get worse before they get better. This is another market cycle. That is the way that we are expecting to see things go. When that happens, you are going to see people go from uncertainty to fear, and that's when you see the major decline portion of an equities market, because people who are late to getting out finally start getting out at 20 and 30% losses.
See late 2008, early 2009.
Exactly. So you've got the early guys that get out at 5 or 10% losses and are sitting in cash right now. You have the late era that gets out at 30 to 40% losses. And they just start running for anything at that point. And it probably bypassing cash and going straight into safety assets. So that's why in 2008, when the market crashed, it wasn't until 2009 gold started going up, in 2011 that it actually peaked. So be patient with your gold positions. And it's not a lot of you, but there are people out there who are wondering, why are these things not lining up on a day-to-day or at least week-to-week or month-to-month basis? And it's because it takes time for large portions of money and large groups of people to follow their madness of crowds, as Charles Mackay's book would say.
All right, Miles. So gold is one thing, silver's another. It hasn't been without its swings here lately. Let's dive into that a little bit too.
Yeah, I mean, silver continues to look very volatile. You look at the gold chart, and we had this great reversal here on the Fed announcement, and lo and behold, that reversal actually happened above the previous low back on the 16th. That looks like stair steps. You're putting your foot down on the stair step, but that next step up is higher than the last one. So that's still long-term bullish activity. Well, you bring up silver, seeing the exact same thing. A lot of volatility. You're seeing the price swing up and down pretty significantly. But same thing, we're still at a higher low. We're still stepping upwards long term. And if we can get above some of these previous highs, like in silver, say we get above $22, you can see here on the chart, that starts looking very bullish going forward. And we could see that in the next couple weeks.
Oh, for sure. We did not get down to that roughly 2040 figure, which was a Fibonacci support level. And that's what you're saying is a higher low. The fact that we didn't come down and touch that. So that's very encouraging.
Yeah, we still actually have a ways we could go down and still continue to look very strong.
And same with gold. So
exactly.
Both charts are very encouraging.
And what about my favorite investment metal, platinum? Same thing. It looks like we're seeing a little bit of reversal potential here as well. So I don't know if that's happening. I don't like calling reversals this early. We're talking about movements back up on a single day. So I don't like calling reversals that early, but it's certainly possible here as we move deeper into the summer and looking what the Fed's doing and looking at what the dollar's doing. And it's rough for the 90% stock investor right now.
Well, I wouldn't want to be in the shoes of the Fed, that's for sure. I mean, they've got a tough task, but in my opinion, they're going to have to reverse. They're trying to raise rates in a declining economy. Inflation has been rampant. Recession is the word of the quarter, where it's now an expectation, and they're raising rates into that. Now, will it slow down inflation? Absolutely, but to what expense, right? There are going to be a lot of victims of this, but to me, it will become both politically and socially too great for them to bear, and they're going to turn from hawks to doves and likely reverse and probably have to increase rates at some point, and that trough start to get refilled. Because, again, it's going to be too sensitive. Inflation and debt, what people will start to realize, both of those are tools of wealth distribution. The interest rate hikes certainly help the banks, but they hurt the consumer. They hurt the spender. But inflation and debt ultimately are very destructive to the lower and middle classes. And so, in my opinion, I think that they're ultimately going to have to reverse. I don't even think that they can make it until this time next year without once again having to lower rates or, again, start quantitative easing.
Well, and if you think inflation is bad, you should listen to David and Kevin's piece about what happens during a deflationary depression. And frankly, how gold actually does as good or better during a deflationary period than an inflationary one.
And gold actually does best during stagflation, right? We talked about that on the show back in October. And now it's also a new word of the quarter. You got persistent inflation with high unemployment, even though they claim it's 3.6%. It's actually over 25%. But that's a persistently slow economy is what we're experiencing.
Yeah, in fact, the only economy that gold does poorly in is a healthy one that's just riddled with truth and honesty.
And positive rates of return.
Anything other than that, gold actually is your friend.
So there's some really key points here that I also want to encourage the gold investor through. One is when the U.S. dollar is above 102 on the dollar index, gold goes up within the next 3 to 6 months, 100% of the time. And it already has started to. Now, when gold is less than 2.8% of M2, okay, the money supply, it also tends to go up. Well, with both of those in a 12-month outlook, each standing on its own, gold goes up 24% on average. Well, you've got a negative real rate of return of 6% now. You've got 8.6% inflation. You have 2.5% interest rate. You have a negative real rate of return of minus 6.1%. That's very bullish for gold, despite the rate hike. Well, guess what? When all of those align, it goes exponential, not only for 12 months at 24%, but at the 24-month and 36-month return, you're looking at between 70 and 100% increase in the gold price historically. So hold on, put on your seatbelt. Miles, as you started the show, stay patient with your gold position. These are slow turning ships, but you're on the right ship.
That's going to do it this week for Golden Rule Radio. As a reminder, there's a couple links below. Check out Kevin and David this week on the McIlvaney Weekly Commentary. If you've never heard a single one of their shows, make this week the one you listen to. And make sure to check out Morgan's piece, Hard Asset Insight, and Doug Nolan's piece, The Credit Bubble Bulletin. You can find links to those below as well. Stay vigilant. Join us in the comments if you have any questions. You can also find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. If you'd like to discuss your personal portfolio, give one of us a call here at 800-525-9556. Thanks for listening and have a great week.